In today's video, I will walk you through the process explaining how I profited from shares of Nvidia falling with a hedged stock investment structure. Even though this strategy was perfectly executed and the profit was maximized, I do not consider this a good strategy. I will explain the difference between a bad strategy, which is short-term in nature, and a good strategy, which is long-term in nature. Let's begin. My strategy ran from March 4th through March 6th, and because the time frame was only 3 days, the strategy is not tax efficient as the profit will be classified and taxed as regular income. When I implemented the hedged structure last Wednesday at noon, the stock was trading at $182.60. The stock closed at expiration on Friday 2.5 days later, call it 3 days later, and the stock had fallen 2.6%. During that time frame, my profit was maximized and I realized a gain of 0.5% even as the shares fell 2.6%. The strategy that I implemented consisted of selling a cash secured put. I implemented the strategy twice over a period of approximately 10 minutes. Keep in mind that each put option contract represents 100 shares. I will walk you through the top trade on the screen here, which is essentially identical as to the trade below. So when shares of Nvidia last Wednesday, March 4th were trading at $182.60, I went out into the options market expiring just 3 days later on March 6th, and I sold a put option at a strike price of $177.50 and received hedged income of $1 per share. This meant that come option expiration just 3 days later, if shares of Nvidia, which were trading at $182.60, would close below $177.50, then I would be contractually obligated to buy shares of Nvidia at $177.50, regardless of how much lower at that time shares might be trading at. In exchange for entering into this contractual obligation, I received hedged income of $1 per share. Let's take a look at the stock chart to see what occurred. On the left side of the screen, represented by the vertical green bar, is the time period when I entered into the hedge. At this time, shares of the stock were trading at $182.60. Looking on the far right side of the page, highlighted is where the stock closed at option expiration just 3 days later. The stock closed at $177.80. Literally just above the strike price or the contractual purchase price of $177.50. What this means is that I threaded the needle perfectly. This was the perfect hedged strategy for the stock for this period. Yet, even though the strategy was optimized, I will show you in a moment why this was not a very good strategy. To demonstrate this profit, let's take a look at trade confirmation at option expiration. Once the market closed on March 6th, 2026, the options I had sold in Nvidia expired worthless, meaning I was able to keep the entire hedged income that I had received and had no subsequent contractual obligation. Even though I optimized this strategy and maximized the profit, I still think it wasn't very good, and let me show you why here. So the at-risk capital that I deployed for this strategy was $177 a share and 50 cents. If the stock would have closed below this contractual purchase price, that's what I would have been obligated to buy the shares at. In exchange for doing so, I received profit of $1 per share. Keep in mind that I implemented the strategy twice, which meant that my at-risk capital was $35,500. In exchange, my maximum profit potential was $200. Yes, I did keep that profit of $200 against my at-risk capital of $35,500, but when you think of it this way, that upside potential to downside risk exposure is not very compelling. Advocates of short-term hedging structures advocate that if you just look at the rate of return that you can receive on a short-term time period, such as this strategy's profit of 0.5% over 3 days, and extrapolate or annualize that profit, the amount of returns that you can generate over a 1-year period is astronomical. Yes, in theory that is possible, but in reality that won't be the case. The reason why these premiums were so high this week for put options of Nvidia is because there was an attack on Iran last week, the stock market was super volatile last week, and these hedged option premiums were elevated. If you think you can consistently implement this strategy with this risk-return trade-off for short-term positions, that is not the case. In most normal weeks, the premium received will be much less than what I was able to command last week. And also there are going to be periods where the stock drops precipitously. If you would have implemented this strategy a couple of weeks ago when the stock was at $200, you would have lost money because the stock now trades at approximately $177. This brings us to the 4 problems associated with short-term hedges, which include covered call funds. Covered call funds typically invest with hedged structures that are measured in approximately 1 month or 4 weeks. What is the difference between a 3-day speculative hedge and a 4-week covered call hedge, to me, they're both relatively speculative in nature. The first problem with short-term hedges is the risk-reward trade-off. As you can see from the example, yes, I optimized the profit, though there was more risk than there was potential reward to the strategy. The second problem is strategic planning. You cannot strategically plan your long-term investment portfolio if you do not have confidence what shares you may or may not own over the very near future. The third problem is tax efficiency. Given that this short-term profit that I generated, or the short-term profits that are generated from covered call funds, have a time horizon of less than 1 year, the profits are classified as short-term capital gains and are taxed as regular income. The fourth problem is market watching. If you are investing with short-term hedges or even in a covered call fund, the hedged income received does not provide any kind of significant buffer of downside protection in the event that stocks turn lower and lose value for you. These are the 4 problems associated with short-term hedged investing. So what is the solution? The solution is to extend that time horizon to long-term hedged investing. Here are the 4 benefits associated with long-term hedged investing, which is realized through customized hedged portfolios. The first benefit is optimizing a risk-return balance. Given that the time horizon is longer, the amount of downside protection is greater, and the risk-return trade-off is optimized, as you will see from an example I will provide in a moment here. The second benefit is strategic planning. If your time horizon is longer, then you have much greater visibility with respect to what shares you will own for a particular time period, and you can strategically invest. The third benefit is tax efficiency. When I talk about long-term hedged investing, I'm referencing a time period that extends beyond 1 year. If you have a hedged position that extends beyond a year and the profit is realized, then the profit is classified as long-term capital gains and is taxed advantageously. The fourth benefit is market watching. If you are investing in a longer time horizon, then the hedged income that you receive serves as a buffer of downside protection in case stocks move lower, and you can feel more confident that you have some degree of insulation from your investments should stocks move lower, meaning that you are not going to be beholden to where the stock market may be moving on any particular short-term date. This all sounds great, though you may want a specific example so you can better understand. Let me provide that to you. Before we move forwards here, let me just clarify that this does not constitute investment advice. There actually, I think, are better strategies for Nvidia, so this does not constitute investment advice. With that said, let's take a look at the same strategy for Nvidia deployed successfully this week over 3 days with a time period of just over 1 year. With shares of Nvidia currently trading at $176, the strategy consists of going out into the options market to March 19th, 2027, which is 1 year and 10 days from now, and selling a put option with a strike price of $170 a share and receiving premium of $27 per share. As a quick reminder, the cash secured put strategy consists of not buying shares today. Instead, the strategy consists of holding cash in your brokerage account, which is equal to the amount of money that you will require to buy the shares if the shares move below the contractual purchase price, the strike price, by option expiration. So in this strategy with shares at $176, you do not buy shares today. Instead, you hold cash in your brokerage account of equal to $170 per share. In exchange for entering into this contract, you receive hedged income of $27 a share. Now, on that cash that you hold in your brokerage account, you receive interest on the cash until option expiration. Let's assume that the annual rate of return that you will receive on your cash is 2%. This means that from now through option expiration, you will receive approximately $3.40 a share of interest on that cash held. Let's take a look at the return metrics for this hedged strategy of 1 year and 10 months. The hedged income received is equal to 15.9%. If this does translate to a profit at option expiration, then this profit is eligible for tax efficiency as the time horizon extends beyond 1 year, and if the profit is realized after a year, then the hedged income is taxed advantageously at the lower capital gains tax rate. For the cash held, income generated is equal to approximately 2%. The sum of the hedged income of 15.9% plus the interest on cash, 2%, is equal to 17.9%, meaning that the maximum strategy profit over the next 1 year and 10 months is 17.9%. In the event that shares move lower and close below $170 a share, the contractual purchase price, then the amount of hedged income and interest received on cash serve as a buffer of downside protection, meaning that the shares from today's price of $176 would have to fall more than 21% in order for the strategy to lose money. Between the contractual purchase price of $170 and this break-even price, there are profits that diminish as the share price declines from $170 to that lower break-even threshold. I hope I've been able to demonstrate the benefits and drawbacks of short-term hedged investing and also sufficiently articulate the benefits of long-term hedged investing. If you have any questions or comments, leave them in the comment section and I will try to respond if I can. Thank you for watching.